Most U.S. institutional investors allocate less than 10% of their real estate allocation to REITs. So I think that indicates a big underweight that they're probably not aware of. They probably don't realize the REITs are as big as they are.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today I'm speaking with Bill Maher, Director of Strategy and Research at RCLCO Fund Advisors, a leading real estate advisor to institutional investors. Bill is here to discuss some of the key developments he's seeing within the REIT and broader commercial real estate market today. Bill, welcome to the podcast.
Oh, it's my pleasure.
How would you describe RCLCO Fund Advisors and your role in the institutional real estate world?
So RCLCO Fund Advisors, or RFA as we call it, is a group within the company called RCLCO, which I'll describe in a minute. We advise institutional investors on their real estate investments, broadly speaking. We advise on strategy. We help set up separate accounts and joint ventures. We evaluate fund investments, and we actually underwrite specific deals. Our clients include some of the larger public pension funds and increasingly non-U.S. investors. We also serve as an outsourced real estate consultant to a state fund with about $50 billion in total assets. RFA has been advising institutional investors for a little over 10 years, but our parent company, RCLCO, was formed in 1967 and has been providing real estate consulting services to various players in the real estate industry for more than 55 years. RCLCO leverages quantitative analytics and a strategic planning framework to provide business planning and implementation solutions. So our RCLCO has deep experience with all product types. So we like to say we approach our institutional advisory business with a demand and product-oriented approach.
Recently, you and a colleague wrote an article in Priya Quarterly about academic research that has concluded that closed-end private real estate funds may be underperforming. How do REITs fare in those studies?
The short answer is REITs fare well in those studies. My colleague Taylor Mammon and I, who's the CEO of RFA, we've seen a number of articles, mostly academic articles, that have delved into the performance of private real estate funds. And this is something we've felt and thought was going on, but it's really helpful for the academics to look carefully at all the data. They have data we don't have access to. And so we wrote a paper that summarized a lot of that recent research, and we called it, the title was Academics Question the Value of Private Real Estate Funds, What's an Investor to Do? It's one thing to say that funds are underperforming, but we really have to have a strategy to account for that. The article was published last month in the fall 2023 issue of Priya Quarterly, which is available for free on Priya's website. So I'd urge anyone to go look at that article, plus all their other articles that are part of Priya Quarterly are now free to the public. So we summarized recent academic research related to the underperformance of closed-end real estate funds. We presented some ideas as to why these funds have underperformed, and we suggest and evaluate alternative approaches that investors could utilize. In particular, we argue that more direct approaches to investing in real estate, such as joint ventures and separate accounts, better address the characteristics and opportunities and risks associated with real estate. We also state that REITs should be an important part of an institutional portfolio, along with levered core and more direct structures. Another article that talks about REITs was one done by three academics named Tom Arnold, David Ling, and Andy Naranjo. And this was done in 2021. And they found that closed-end real estate funds underperformed REITs and had comparable performance to the NCREIF Odyssey Index, despite having generally higher risk. And they looked at the 2000 to 2019 period. So the recent studies have used different benchmarks and different comparisons, not always using REITs as a benchmark, but given the studies we have looked at, I'm pretty sure that REITs would have fared well in any comparison to private real estate investing.
How important are fees and execution costs when it comes to comparing investment returns?
They're very important. Fees can get very large that are charged by the private real estate funds. One of the papers we looked at was called 3 Decades of Global Institutional Investment in Commercial Real Estate, and it was published in the Journal of Portfolio Management in their special real estate issue in 2021. And they found that average costs of real estate investments have stayed more or less stable over the past 30 years at about 114 basis points on average. And it's been higher in the U.S. and than other countries. but only 17 basis points for listed real estate. So it's over 100 basis points per year of additional returns, just based on the cost to run a private real estate program versus the public real estate program.
Now, since you wrote your paper, Hodes, Weil, and CEM have released analyses of institutional allocations to real estate and the performance of different asset classes within defined benefit pension plans. Is there anything in those analyses that supports or contradicts your article?
First of all, I want to commend Nareit for partnering with Hodes, Weil and adding a section on REITs to the well-regarded annual institutional real estate allocations monitor that Hodes, Weil has been doing now for years. The report finds that about 36% of institutions reported investing in REITs in 2022, including 52% of large institutions, and more specifically, 65% of large U.S.-based institutions. And then when asked about future intentions, 42% reported they're planning to allocate additional capital to REITs, and that was led by sovereign wealth funds at 64%. Obviously, REITs are an important part for many, but one of the things that surprised us was that not almost all institutional investors are investing in REITs. So I think there's an opportunity there to improve the risk-adjusted returns and performance. And they also pointed out that there are multiple reasons to invest in REITs, which we know because they provide a lot of different benefits. But in that survey, 46% of the respondents identified liquidity as a leading objective for investment. Another 38% responded that they invest in REITs as part of their core strategy, which I think makes sense. And then there are other reasons, including broadening exposure to certain real estate sectors and strategies. I think we can talk about that later. And then access to international markets, which REITs do a really good job.
How does the REIT market compare in size to the core institutional market?
Yeah, that's a tricky question. There's a lot of different ways to calculate the various sizes. According to an analysis by LaSalle as of year-end 2021, REITs account for approximately 36% of the institutional universe. That includes all types of real estate, including higher risk strategies. If you consider REITs to be a core in terms of risk and return, which I do, REITs have a bigger share of the U.S. core market, probably north of 50%. And most U.S. institutional investors allocate less than 10% of their real estate allocation to REITs. So I think that indicates a big underweight that they're probably not aware of. They probably don't realize the REITs are as big as they are.
How important is it for investors to broaden their exposure to commercial real estate through a range of investment models or strategies?
Sure. Institutional investors are always trying to meet their investment objectives, which are typically 7 to 8% returns net of fees for real estate, in addition to diversification benefits that come from those returns, and that have low correlations to other asset classes. And of course, they want to do this with the least risk possible. So they're always looking for new models and strategies, being that property types, geographies, and investment structures.
Where do REITs fit within this exposure, and how have they performed relative to private real estate?
Well, U.S. REITs are much more diverse than private real estate in terms of property types. The Nareit index has over 60% of its property value in niche or specialized property types, compared to less than 10% for NCREIF. The NCREIF share is growing rapidly, but will be well below the Nareit share for decades probably. In terms of returns, CEM, company out of Canada, just released its benchmarking study for 2023. This study was actually sponsored by Nareit, and it provides investment performance across asset classes over a 24-year period using a unique data set covering more than 200 public and private sector pensions with nearly $4.4 trillion in combined assets. The top performing real estate strategies in terms of net returns over the 24-year period were tied between listed equity REITs and internally managed real estate. They produce an average annual return of 10.9% over that 24-year period. After that was opportunistic funds at 9.3%, which is close, but you would argue there's a lot more risk. And then core funds at 8.7%. So I think that over a long period of time, REITs have shown that they are at or equal to many other real estate strategies.
Are your institutional investor clients raising certain questions or topics more frequently than others in relation to their portfolio allocations or the state of the market in general?
The two biggest questions we get from clients these days is what to do about their office investments and how can they access the fast growing or overlooked real estate sectors such as data centers and single family residential. And it's interesting that if you look at the composition of U.S. REIT market, offices of a very low exposure, about 6% the last time I looked, compared to over 20% in the NAREIT world. And then REITs also have large companies that focus on towers, data centers, single-family residential, all of the so-called specialty or niche property types that are fast-growing and have really good demand stories. So REITs do kind of answer the question that a lot of these institutional investors are posing.
Bill, are there any interesting examples where you've helped your clients implement a REIT investing program?
Yes. One of the popular areas that institutions are looking at REITs is called a completion strategy. And that gets back to the fact that most of the private real estate funds and strategies focus on the four main property types, where REITs offer exposure to many other property types. So you can use a customized REIT strategy to overweight or focus on the specialty property types. So we worked with a client to put that in place about 5 years ago and to increase their exposure to property types such as data centers, single-family residential, towers, life science, self-storage. And it was very successful in terms of creating better diversification in their portfolio.
Bill, are you seeing or do you anticipate any shifts in allocations among your investor clients?
I'd say that the institutional investors move fairly slowly, so not major shifts. Again, at the margin, I think that they would really like to reduce their office exposure, so that will be ongoing. And again, I think that they will continue to want greater exposure to specialty property types. They'll look first to REITs because it's very difficult to access a lot of those property types with a private strategy.
But we've covered lots of ground today regarding REITs and commercial real estate investment. Is there anything else you'd like to share with our listeners?
Definitely. So in my view, REITs and open-end real estate funds are the best way for smaller institutions to access real estate. The advantages are fairly obvious: low fees, liquidity, diversification within real estate, and just simplicity of execution. Once you get to mid-size and larger institutions, I really feel that those type of institutions should have a permanent long-term position in REITs for diversification, market knowledge, exposure to property types that are difficult to access in the private markets. I've been following the REIT industry for over 30 years, and I would say some of the other positive attributes include very experienced and professional management teams, very little or no conflict of interest, and capital market flexibility due to their size and their expertise within the capital markets. I'd say that the optimal allocation to REITs among these larger funds will vary a lot depending on their return objectives, their need for liquidity, the ability to access specialty property types directly. But I think it's fair to say that most institutional investors would benefit from a greater exposure to public traded REITs.
Bill, thanks again for joining the podcast.
My pleasure. It's been really interesting.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.